Too many people get caught up in the day-to-day, in the newest news, in the CPI inflation numbers, in whatever kind of articles get published around crypto. But what really is important is the long term. And what's interesting about this is that we see long-term trends changing. What used to be very common, very popular investment advice just 20, 30 years ago has completely flipped today. In this video, I want to talk about the changes that happened in the past and about the likely changes that will happen in the future. It's very important not to get caught up on the wrong side of history, because then things, of course, don't turn out too well. Now, here is where a lot of people got caught off guard. It is the 60-40 portfolio. This was a very common advice not too long ago, to own 60% stocks and 40% bonds. Nowadays, nobody wants to own bonds anymore, right? Nowadays, people own stocks, ideally technology stocks, potentially some crypto, potentially some gold, but bonds are pretty much out of favor. Now, why did they fall out of favor? And does it potentially make sense to buy them today, right? We should always buy the thing, apparently, that nobody wants to buy. We want to be contrarian. Does it maybe make sense to sell some Bitcoin and buy some bonds? Let's have a look at some data. This here is TLT. So this is a long-term government bond exchange traded fund, an ETF. The chart starts in 2002 and prices developed very, very nicely up until the year of 2020. Long-term bonds more than doubled to then come crashing down when monetary tightening was introduced again. Over those more than 2 decades, prices increased by only 8%. But on top of the price development, there was also coupons, an average of 4% per year. Now, what was the idea behind this 60-40 portfolio? Why did people buy bonds with 40% of their wealth? This here is the reason. What we see in red is the S&P 500. And again, what we see in green is TLT, so our long-term government bond ETF. Of course, stocks outperformed long-term. But the reason to also own long-term government bonds is as a protection against potential stock market crashes. So have a look over here at the global financial crisis. Long-term government bonds went up in price, or have a look at the COVID crash over here. Again, long-term government bonds went up in price. And what we see here at the bottom in white, that's the 1-year correlation coefficient of long-term bonds versus stocks. When this white line, the correlation coefficient, moves between +1 and -1, it's randomly fluctuating. That means that the price development of stocks and bonds aren't connected. In other words, if stocks crash, the bonds can potentially go up. But what exactly has happened? Why isn't the new...
To get the full length video, feel free to simply subscribe over here. Then you get it recommended by the algorithm.